Good morning, everybody. Welcome to this update for global and Australian markets for the 6th of September, Father's Day, and I hope all the dads out there have a great day. And you'll be able to tell that my voice has improved dramatically since last week, so that's a good thing as well. Okay, let's have a look at what's likely to unfold during September. August was one of the worst months that we've seen since the GFC. So if you were struggling to make headway in August, then that really is the reason why. But I guess the key thing is how is September shaping up at this stage? But just before I get to that, I just want to address a bigger picture concern. I've had a lot of questions from members and from also from a few non-members about some of the sensationalist reporting that's going on at the moment. And I just want to be really clear about my view on how I read things. To me, this is not the start of a bear market. Now, there are plenty of very irresponsible people out there that are creating headlines to either sell newspapers or sell subscriptions to newsletters or whatever. It is in their interest to scare the pants off you, and some of them are doing a fairly good job of it. But really, they're being very selective with the facts, and they're not achieving anything productive. They're just really causing people a lot of unnecessary concern, in my view. There's a tendency for only the negatives to be reported at the moment, and I'll give you an example of that. To my mind, and I think, look, to most economists or anyone that's looking at this, looking at the facts dispassionately, rather than trying to create a sensational headline, the US economy is in acceptable shape. There are certainly there are a few issues, but it's going better than just about anywhere else around the world, and there are some bright spots in America. There's no question about it. So there really is no, or I shouldn't say no, there is very little likelihood of the US economy going into a recession at this point in time. Now, US stock valuations are generally okay. There are a few expensive parts, but you'll always get that in any stock market. And some of them are exceptionally cheap, and specialist share education members will know the stocks that I'm talking about, some of the world's great stocks that are trading at very, very cheap PE multiples. So to say that the American, to selectively use some data to say that the American market is overvalued is just not true. So please beware of painting all stocks with the same brush. It's just not the case. There are still some great buys, particularly in America. Now, let me just give you an example with oil. Now, supposedly, what a lot of the people that are focusing on the negatives are saying is because the oil price is low, it means that global demand is low, and that therefore all economies are in trouble because the demand for oil is falling away. Well, the reality is something different. The demand growth for oil, so the growth in demand month by month, is the strongest in 5 years. That's the reality. So what's happening with the oil price is simply about oversupply, and eventually any situation of oversupply eventually corrects itself over time. I don't know how long it will take for the oil price supply and demand to come back into balance, but it will. And it'll be a correction of that balance. So this is reality. This is the demand for crude oil. Now, how anyone could look at that chart and say that there is a reduction in the demand for oil and therefore economies are in trouble, I'm scratching my head. I can't see it, and I don't think anyone else can either. So that's just one example of some of the negative reporting that's going on at the moment. Now, just looking at bear markets in general, there are several preconditions to get a bear market in stocks. One is you have to have a contraction in liquidity, and that triggers a sharp economic slowdown. Now, I'm sure I don't need to explain to anybody that we've got Europe on maximum stimulus, we've got Japan on maximum stimulus, we've got China that's now starting to stimulate their economy again. America is hardly in contracting liquidity. There's still considerable doubt over whether they'll raise interest rates this year. So that one is not even remotely in sight. The second thing is a level of exuberance. And what that means is that all the money is in the market. and we certainly don't have that. People have been nervous and negative about this bull market since 2009. The next thing is excessive valuation, and I've already addressed that, and we certainly do not have that. And I just want to point out that since 1987, there has never been a bear market that wasn't accompanied by a recession. So if you accept the premise that the American economy is not about to fall into a recession, that it is growing, then history is certainly against having a bear market. But all the other preconditions for a bear market aren't met either. So the only way that I could see that we could possibly get a bear market is if US stocks were significantly overvalued, and I maintain that they are not. So looking at American stocks, the S&P was down by 68 points on the week. It was a real roller coaster ride, though. Some spectacular ups and downs. And really, stock prices in America have disconnected from the US economy. Stock prices should be doing a lot better than they are, and they should be tracking along with the US economy. But in the short term, that's not happening. What is happening is that markets are tending to trade along with the erratic behavior of the Shanghai Composite Index, and that's just really all about emotion. And that's not a way to trade, and it's certainly not a sustainable situation. We will get back to the situation where stocks will be tracking along with the economy. But having said that, markets are nervous. There's still the potential for downside. And so this is very much a time for buying only outstanding investments, nothing else. This is not a time to be trying to pick bottoms in speculative markets or anything of that nature. This is a time to just stay with outstanding investments, outstanding businesses. Now, the jobs report on Friday night in America was inconclusive. It was neither great nor poor. And so that still leaves everyone in a state of confusion about when the Fed will start to raise interest rates. And of course, markets hate uncertainty. So I really saw Friday night's job report as probably short-term negative for the market because it didn't clarify anything. So all eyes now turn to the Fed meeting in 2 weeks. And that will be another one of the major drivers of stocks over the month of September. The decline also in America is a lot about algorithmic trading and index trading. And so therefore, this is not a market that's representative of the fundamentals. It's a market that's being pushed around by computer programs. And therefore, in the short term, anything is possible. The capitulation low of 1822 points that we saw on the that flash crash we had the Monday before last, that may get tested again, and it's possible a lower low could be formed. I really have no idea in the short term, and with the amount of computer-driven program trading happening, I don't think anyone else can feel confident about it either. The week's action we've just had suggests that lower prices are still to come. I think that's the higher probability. I'm not saying it will happen, but I think it's the higher probability. So let's look at the S&P index. So we'll start first of all with the monthly chart, and you can see there's certainly been some technical damage done. Now, this was what occurred in 2011. We looked at this last week. We had a little bit of a tailing off in June and July, and then we had a significant down in August. In fact, it was very similar. You can see this August and the one just gone were very similar. They're a very long range candle, but closed well off its lows. And then September went down again in 2011, which at the time, and 2011, if you think back, was a pretty significant time. That was when it looked like Greece was going to leave the Eurozone, and the Euro as a currency may collapse and cause enormous turmoil. Now, the circumstances that we have now are nowhere near as severe as 2011. So if that was the market reaction then I really struggle to find a case to see why all of a sudden we're going to start to go into a bear market. But can September go down a bit further than it already has? Yes, it could. It could go into a deeper pullback. Let's look at the daily chart. Now I've just put an additional Fibonacci scale on here just to get a measure of the rebound. I said to you last week that the way that things were shaping up would depend a lot on how the market rebounded from this a big initial plunge. It made it past the 38.2, which is a good sign. Didn't quite make it to the 50% level and then started to fall away again. So again, it just doesn't give me a strong view either way. If this had only just limped up to the 38.2 and then turned over, I would have thought there's probably a lower low coming. The fact that it got up as high as it did means that there's just a little bit more buying strength in the market, but it's really very difficult to read. So hence, I think September is going to be a month to sit back and, as I said, just really be focused on the really, really good stocks. Looking at the Australian market, the Aussie dollar broke 70 cents. So this very severe downtrend continues. And this is a major break of long-term support. If you remember the chart that I put up last week on the Aussie dollar. So a very significant break. I always thought we were a chance of getting down to these levels, but this has happened way, way quicker than I envisaged. The ASX 200 index lost 223 points for the week, and I would imagine it'll be down again on Monday. And clearly, there's some overseas program selling occurring, and I think that's largely about the Aussie dollar. So much of our market is owned by overseas funds, and they're getting an absolute pasting on the currency. So I'm sure that there's a level of overseas selling occurring, which is not a good sign for the Australian market. Commodities, gold declined $10 for the week, and really there's nothing more to add to the gold story than what I've been saying of late. So let's look at the Australian market first of all. There's the Aussie index. We're still in this significant downtrend. We had a little break to the upside. We had a little false break to the downside, but we're still contained within this downward trending channel, and we've gone beyond support. So 51.30 odd support has now broken. You'd be a brave man to say that 46.28, 46.50-ish was not a possibility. I think we could easily lose another 300 or 400 points on the Aussie index. So just be very, very careful in the Australian market. Looking at gold, we'll just look at the weekly chart, and really there's just nothing much happening there, as you can see. No real change. We're still holding this long-term upward trend in gold that goes back, really started this trend line back in 2006. So we're holding it at this stage, but if that breaks, then just over $1,000 has got to come into play. And I would have to say that I'm seeing no action in the gold market that suggests that $1,000 is not a distinct possibility. Turning now to other commodities, copper didn't do much, was steady at 232. Crude oil was steady at 46, but very volatile. It traded down to 39, traded up above 46. So it's all over the place. And I think it's a very brave call to say that the lows are in for oil. I really don't have a feel for where oil may sit or may settle, but I think mid to low 30s is still a possibility in my view. There's the spot copper chart. So just to wrap it up, the overall strategic approach that you should be taking at the moment, short-term trading during September, I think is going to be extremely difficult. It's going to be hard to feel confident in either direction, either short selling or buying long. So I think this is a time to be sitting on your hands. Abrupt reversals, I think, are going to be very much the norm. I think you're going to wake up and see a lot of 200, 300, 400 point moves in the Dow Jones index. I think that's just the way the market is sitting at the moment. So my recommendation to non-members who are watching this is just to focus on the highest quality assets. And if you don't know how to recognize a high quality asset, then you shouldn't be in the market at all, because this is just it's an exciting time. There's no question. There's some terrific opportunities, and members know what I'm talking about. But it's also a fairly dangerous one if you don't know what you're doing. So just take great care during September. Anyone that wants more details on what we do, there's the web address and my email address. Always happy to communicate with people. So that's it for this week. Cheers.